In today's video, we're going to talk about a topic that affects us all, trading risk. Let's face it, trading is risky, but so is anything related to making money. No risk, no money, but we still have to protect ourselves. By the way, many people ask me about the Forex brokers that I use. See them in the description box below. You can start trading Forex, indices, CFDs, crypto, stocks, and binary options with just $5 or $10. Sign up with the links in the description box below if you want to give them a try. Also, see the description box below if you want to download free Forex robots, indicators, courses, and books. Now let's talk about what you do to control risk in trading. Risk management is an essential aspect of trading, yet it is often overlooked by traders. A proper risk management plan outlines crucial information such as what to trade, stop losses, and other important aspects to protect your account from significant losses. Unfortunately, many traders either make a small plan or ignore it altogether, leading to a blown account. When risks increase, traders tend to make irrational decisions, such as closing trades early or taking on larger losses. This highlights the importance of having a solid risk management plan in place to avoid making costly mistakes. Why you need to manage your risks in trading? Traders, especially new ones, tend to spend more time figuring out when to enter a trade, but often neglect to think about when to exit. This is where risk management comes into play. It's not just about knowing when to enter a trade, but also about knowing when to exit, both in winning and losing positions. Limiting losses when your trades are going the wrong way is critical to your success as a trader. You need to determine your risk tolerance and adjust your risk management plan accordingly. Taking on too much risk can cause anxiety and stress, while not caring enough about the risks can lead to irresponsible trades and significant losses. It's a balancing act, and we'll explore some strategies to help manage your risk. Trade sizes. Trading with a large trade size can be tempting, but it also exposes you to larger losses. It's crucial to align your trade sizes with your account balance. Many traders risk 1 to 2% of their account balance per trade, which provides a cushion for losses. If you're unsure of your trade size, it's best to start small and gradually increase it. Holding trades. Some traders engage in short-term trading, while others hold onto losing trades, hoping they'll turn around. This is a risky move that exposes your trade to increased volatility and potential losses. It's essential to set a limit on trade times to avoid holding onto trades for longer than necessary. Stop losses. Stop losses are a lifesaver in trading. They are a limit you set on each trade that automatically closes the trade when the markets reach a certain level. If you're trading a long-term strategy, you may not want to use stop losses, but for short-term trades, they're crucial to limiting your losses. Diversification. Diversifying your portfolio is another way to manage your risk. Instead of putting all your eggs in one basket, spread your investments across different markets and assets to mitigate potential losses. Emotional control. Emotional control is critical to successful trading. Fear, greed, and other emotions can cause traders to make irrational decisions. It's essential to maintain control over your emotions and stick to your risk management plan. In conclusion, risk management is essential to trading success. Implementing effective risk management strategies such as trade sizes, holding trades, stop losses, diversification, and emotional control can help protect your account and maximize your profits. So there you have it. What you do to control risk in trading. And as always, if you have any questions, feel free to leave them in the comments below. Thanks for watching.